All right, fellas, we're gonna get started. We're just making this video so we can cover some of the basics, get everybody up to speed, so we having conversations in the Discord. Uh, you know, you get the terminology, you're not lost in the sauce. So this is the Discord you guys are in right now, so you'll see us talking about everything day to day. Um, let's get started with the tickers. Uh, we just gonna go over the tickers because, like you see in the Discord, you'll see us throw names like SPY around, which is basically the S&P 500, 500 biggest companies in America. Nvidia, the biggest chip company right now. Apple, everybody knows Apple iPhones, Amazon, Tesla, but the tickers here. So if you see us just see, if you see us just say TSLA in there, you know what I mean? Like, obviously that's gonna be Tesla, but you got weird ones like this. So Meta. Maybe not everybody knows what Meta is, but that's Facebook, Instagram, everything. They have WhatsApp. That's all Meta. But the ticker for that is META. Some other popular ones: Netflix, ExxonMobil, Lockheed Martin, big defense company. But that's all the tickers are, guys. And then next we'll go over bullish versus bearish. So if you see us in the chat and say I'm bullish on something, I'm bearish on something. Bullish means I think the stock is going up. Bearish means I think the stock's going down. And that could be long term, short term, whatever. You also have calls and puts. Calls meaning you think the stock's going to go up, so you're buying call option contracts. Puts, you mean stock's going to go down, you're buying put option contracts. Option contracts. So basically what I did was I used Gronk, used the AI, and this is I think the best way that I could look it up and try to explain it to you guys. So what I did was I asked Gronk, can you explain what the option contract refers to trading to a bunch of guys who are familiar with sports betting? I figure most of us sports bet or at least heard of it, so it can be something that is similar, so we can compare it. So this is what Gronk says. We'll skip the first little part, but in sports betting, you put money down on an outcome, just like how we would any game. You Chiefs will win or Chiefs will lose. An option contract, basically the same idea, but instead of a game, it's an event, the price movement of a stock. And the contract gives you the right, but not the obligation to buy or sell the stock at a certain date. So if you guys feel free to like stop the video, screenshot this stuff because I'm just basically reading it to you guys, but I like the example right here, call options. Remember I said before that means the stock is going up. So you have the call options, but this is where I think it's just better than sports betting because it's more manageable. How it works, you pay a premium, which is how much the contract costs. That's all. So I'll pull up the option chain real quick just so we can get a look at it. Just going to use Yahoo Finance. We'll type in Apple. It's the ticker symbol for Apple. So we'll go to Apple and we'll check out the option chain down here on the left hand side. And we'll change it to straddle. And we'll go over another video, guys, with all this so you know how to get here. But so this is the option chain. So when you're ready to start trading, buying contracts, you'll see something like this. They're different in different apps, Robinhood, whatever it is. You'll see the different option chains, but they're all basically set up the same. So right here, you'll see last price. So that's basically what you'll pay for this contract. So you see, it looks like it's $1.67, but when we buy these contracts, you got to remember we got to move everything over 2 decimals to the right. So instead of you seeing 167 like $1.67, you should see that as $167 per contract, and that's what that is. So we go back. So that's your premium. So if the stock shoots up past the strike price, which we'll go over, you can exercise to buy low, sell high immediately, and you would pocket the benefit. So the option contract, you're buying 100 shares of that company, the right to buy 100 shares, not the obligation. So think of it, whatever the price moves up in the option contract, you have 100 of those shares. So let's say, let's go back to trading view. Open up one of the charts. So Meta, right? So if you would have bought Meta right here, let's say at this 602 level, 602 or 605, whatever this level is, and you say, hey, I think Meta is going to go up to this 620 level. Okay, well, you bought here and she shot all the way up to 638. So instead of buying one meta share of meta for 165, the option contract lets you do that with hundreds or a thousand, couple thousand, whatever it is, whatever the price of your contracts are. But options allow you to do that with way less money. You got to think about it. 100 shares at 605. You see what you're paying. You're paying $60,000 for 100 shares. Instead of doing that, you could buy option contracts. Now, just say you bought 100 shares, supposedly with the option contract, and she shoots up to where she shot the very next day to 639. So now you're selling those 100 shares that you bought at 605 for 639. You see that now you're collecting you're collecting off of that gain, off 100 shares, instead of buying one share that you can afford for 600. Now you made what, $38 instead of buying 100 shares and collecting off of that profit. It would be much more on the option side. So let's go over that again now that we understand that you pay the premium, which is just the cost of the option contract. Okay, so right here we're talking about usually for 100 shares. So you buy you for the right to buy at the strike price. So if the stock price shoots up the strike, you can exercise, buy low, sell high for all that, or just sell the option itself for a profit for what it's worth now. All right, so let's go into the betting strategy. It's like a future bet on the player of an MVP. If the stock, your team, performs and hits well, your payout can be huge, unlimited upside. But if it tanks, stays flat or under, you only lose your premium. So let's say the stock went down after you bought for that $300. You bought the premium for $300 and the stock is going down. Well, if you see within a couple days that it looks like it's going down and you've done your research, it doesn't look like it's going to start to recover anytime soon, you can cut the loss early. So instead of sports betting where, hey, I put $100 on the Sixers to win and they're down 30 in the fourth quarter. I can't go back in and try to stop that loss or maybe only lose $50. In options, you can. Let's say you're at let's say you got meta here, and let's say just nice even $500. You paid $500 for uh the price right here. You're at 726, and you're thinking she's got momentum. The next day she goes up. You're holding because you think she's not going to stop the momentum, and then the day after she shoots back down to seven. She eventually goes to 708. Now, if you were here during the course of the day and you seen her falling and you say, hey, I think I'm going to get out. Instead of losing your whole $500, when the stock price starts to fall and you have a certain percentage, you say, hey, I'm done losing that money. Well, you say, hey, I lose 30% of my money, I'm out. You can cut it short. So you can say, hey, I'm only going to lose $250 instead of my whole $500 investment. You can mitigate your loss. That's what earlier when I said it's easier to handle, that's exactly what I mean. And even on Robinhood, they have this cool feature where you can add a stock to your watch list, or even an option call that you bought, you can add it to your watch list. And then you can go back in once you pull up your watch list thing. And I'll show you guys a video on here. But you can go in and actually simulate your return. So I could go, hey, if I bought the option contract today, I want to know in 3 days if I'm at this price, how much is my contract worth, and it'll do that for you so you can actually like forward see what would happen to the price of your contract. So that tool is really cool, and I'll have a little video up for you guys to see it here too. All right, fellas, I'm gonna show you this little the tool I was talking about. So we're just gonna go to Apple, and this is the option chain in Robinhood. Remember, I said they're all a little different. So this is how the one in Robinhood looks. So you just see me switch from calls to puts now. Puts are the red ones, calls are this green ones right here. And up top you'll see the date. But if you hit one of those, they have a add to watch list option. You put them on your watch list. If you scroll down, you see that simulate my returns in the middle of the screen. You hit that. This is that tool. Now you can move the bar on the left or right, and that'll change the date and the time. You can see the date changing July 13th, 10 p.m., July 12th, 10 p.m. Then if you look down the bottom where the price is moving, that's just me sliding it. So you can see where your contract, what it'll be worth at this price or at this date. You can move it up and down. price left and right, and you'll get an accurate depiction. So the expiration date, where are we at? Up here. Okay, so Yahoo Finance shows it up here, but every app, like I said, it'll be a little different. So the expiration date is when that contract is going to expire, meaning that game is over. That play is done. Like it will end on that date, and whatever it is at that price, it's over. That's what either goes back in your account, that's the profit, or that's the loss. It's over after that. So let's see how Gronk describes it. They got a little part down here. The buzzer options expire weekly, monthly, etc. Shorter time equals cheaper premium. So the less the cost for that contract, but less room for the game to play out. So, like I said, sometimes you'll have either a stop loss, which means like if the price goes against you in either direction, you can stop your the loss of your money at a certain level. You could cut your loss early. Again, opposite of sports betting where you can't you once you place your bet, unless you get out before the game starts, it's over. Whatever happens in that game happens in that game. All right, in and out the money. So we'll go back to Safari to the timeline. In and out of the money. Okay. Right now, Apple's at 208, but that's in the after hours. So it ended the price somewhere. Okay, yeah, it's at 208. So we're right in the middle here. So 205, if you were on the call side, meaning you think the price is going up, all these are already in what we call in the money. So that means the price has already been surpassed. So if it's at 208 and you had a strike price of 200 or a strike price of 190, all that means is that your price has already been surpassed. So you're probably, if you had those strike prices, you're already in the money. And then obviously everything that the price hasn't reached yet, 215, 220, 225, those calls are out of the money, meaning that stock hasn't gotten there yet or is still below. Same thing on the put side, just opposite. Meaning if you think the stock price is going down, uh, these right here have already been surpassed. Apple was once at 230, 240, and you put the put when it was there, and now the stock price is at 208. So your puts are in the money, meaning you're in good money, you're in profit. And then out of the money would be something you maybe see the stock going to. So you pick a 190 strike price. That would be an out of the money strike price that you're picking.